If you invest in stock market like mutual funds or ETFs or index funds, you must understand the power of value investing. Allow me 10 to 20 seconds of time. What you see on my screen is Nifty 50's last 1 year performance, and you will very quickly note it's gone up by almost 14% in last 1 year. Now have a look at this index, which is called BSE Enhanced Value Index. What is this index? I'm going to talk about that in a minute. But if you note, as of January 2026, in the last 1 year, this index has delivered around 28% returns, almost double the Nifty from a performance perspective. Now, I'm not saying just because in the last 1 year this index has outperformed Nifty, this becomes the best index and Nifty is the worst index. No, absolutely not. I'm not trying to say that. My point is that we need to understand the power of value investing. And in this video, I'm going to talk about what are the top 3 value related ETFs. What are the risks in these particular ETFs? What sort of volatility we are talking about? And more importantly, under which market cycle these ETFs actually perform, under which market cycles these ETFs do not perform, so that you get a very good rounded understanding about value investing using these 3 ETFs as examples. Humble request that do not take these as recommendations. And these are not for short-term traders or investors. These are only for long-term investors. And before you take any investment decisions, you need to understand the philosophy and of course consult your financial advisor. If you don't know me, my name is Rahul Jain. I'm a SEBI registered research analyst. I do my independent research and share all of that with you on this channel. If you're new to this channel, request you to subscribe and like this video. With that, let's get this video cracking. So the first set of ETFs we are going to learn about today is BSE Enhanced Value Index related ETFs. Okay. Now I personally started investing in this particular index almost 18 months back. You can see on my screen, and the returns have been decent. The performance have been decent, right? I've been gradually accumulating this particular index for my long-term investing. Again, this is not a short-term game and not a recommendation, and don't get influenced by what I am doing. My risk appetite is very, very high, and I'm going to share with you the risk return ratio in a minute. Actually, let's go to the risk reward ratio straight away. What you note here is the comparison between this particular index and Nifty 50. Last 1 year, 3 year, 5 year, 10 year, 15 year basis, this particular index has outperformed Nifty very, very comfortably. You can see the numbers here, right? Very, very healthy outperformance is what we have seen in the last 1 year, 3 year, 5 year, 10 year, 15 year. Now comes the volatility. Okay, how much of fluctuations this index brings, and this is where I really want you to focus on, because if you see 1 year, 3 year, 5 year, 10 year, 15 year, the volatility has been very, very high, almost 8 to 9% more volatile than Nifty 50. So this is not for people who get panicky by seeing their portfolio going down by 15% or 20%, and if the market crashes, these indices, because these are factor-based indices, they could come down a lot than Nifty. So you have to understand that point from a risk perspective. Okay. Third point is the risk-adjusted return. So okay, fine, we understand there is a risk. What about risk-adjusted returns? So 1 year basis, 3 year basis, 5 year basis, this particular index has comfortably beaten the risk-adjusted returns of Nifty as well, as you can see here. But on a 10 year and 15 year basis, this has given poor risk-adjusted returns. Okay. Now, why this is so? I don't have any thesis on it. It might be because of various factors in terms of, if you go back to 10 years, 15 years history in terms of economic conditions of India or whatnot. So I don't have anything to pinpoint why this has not given good risk adjusted returns on 10 year, 15 year basis. But 1 year, 3 year, 5 year basis, I've shared the data with you, totally unbiased. Okay. So now you understand the return profile, you understand the volatility or the risk profile, and also you understand the risk adjusted returns. What about index SIP returns, Rahul? So here is the data for you: 1 year, 3 year, 5 year, 10 year, 15 year. As you can see, healthy SIP returns as has been calculated by Motilal Oswal. Again, not a recommendation here that you invest in this, but you can see the data yourself. I'm trying to give you totally unbiased commentary. And if you're liking that, request you to hit the like button. Let me know in the comments. A simple thank you. With that, let's also look at the rolling returns. Now the fun comes. Okay. 3 year rolling return, 5 year rolling return, if you look at average basis. So 3 year rolling return average performance has been around 15.63%. If you look at the 5 year rolling, 13.57. So it's not that from a rolling return perspective, it's given like 20 or 25. No. Absolutely not. Around 13 to 15% depending on the time period that you look at. But more importantly, look at the minimum performance or the drawdowns as we call it. Here you see minus 20% from a 3 year basis. So there have been instances where it's gone down like crazy. Okay. 5 year basis, As well, 9.73%, slightly lower, not slightly, actually a lot lower, but you get the point that these are highly volatile indices. Now let me talk about the market cycles, and this is the most important point you need to understand about value investing. Okay, so typically value investing, if you go back to historical data, in the bull market, they do not perform that heavily, right? I mean, they will give you returns, they might give you decent returns, not saying that, but their actual performance comes in the recovery period. As you can see, value factor works like a charm when the market is undergoing recovery. Okay, so you have the bull market. After bull market, you will have crash correction or a bear market, and then slowly the recovery will start. Okay, during that recovery phase is when typically this particular index or the value investing in general has performed well, because people look for safe havens or companies or stocks that are giving attractive valuations, because everybody is coming out of a bear market and they're fearful. They don't want to take a lot of risks in the high PE stocks or high PB stocks, right? Therefore, we see that during the recovery phase, these particular indices work well. As of now, we are in recovery mode in my assessment when it comes to Indian stock market. I'm talking about when I'm recording this video in February 2026. I don't know when you're watching this video. The cycles might change very, very quickly. But if we hit a bear market, in that case, they do not perform. Please understand this point very well as well. Okay. In the bear markets, your best bet will be either the quality or low volatility. Again, these are the topics that I'll cover at some point in time. So if you're still new to my channel and haven't yet subscribed, do subscribe, because I'm going to bring all of this content to you at zero cost with a lot of data analysis, right? Now the natural question, Rahul, how is this index even constructed? So you go to BSE large and mid cap space, or look at the BSE large mid cap index. There is an index called BSE large mid cap. From that, you select 30 companies purely based on the attractive valuations. Okay, I'm going to talk about the valuations in a minute, and then you have some weight rules. Again, I'm not going to go into details of that. And then there is a rebalancing happen every 6 months in March and September. And the good times for these sort of indices is when the rebalancing has happened. So if you ask me, in the month of April, the March rebalancing would have happened. You get the latest sort of stocks included or excluded. That might be a very, very good period to go and look at this particular index, right? This is how this index is constructed. Now let me talk about the valuations, the value score, PE ratio, PB ratio, dividend yields. These are the three factors that particularly the value score is calculated based upon. And what you note is the gray line is the Nifty 50 PE ratio, and the blue line is the BSE enhanced value index is PE ratio. Likewise, PB ratio, dividend yield percentage. What you note very quickly is that this particular index only includes those companies where the PE ratio is very, very low. Likewise, the PB ratio is very, very low, as you can see in the blue line, and the dividend yield is on the higher side. Okay, and I don't think you need to guess it. As of now, these are mainly PSUs. Okay, you can see the top 10 companies in this particular index as of December 2025, and you will note that Bharat Petroleum Corporation, State Bank of India, Hindalco, IOCL, ONGC, Hindustan Petroleum, all of these companies are PSU companies. Their PE ratio, PB ratio, and their dividend yield is very, very high. From a sector perspective, financial services 41%, energy 39%, commodities 14%. Again, these things will continue to change, right? Because the rebalancing happen. When it comes to now ETFs, how many ETFs are there for this particular index? As of now, there is only one. Okay, that I could find. Again, I don't know when you're watching this video, there might be more coming up soon, but as of now, there is only one by Motilal Oswal. Again, not a recommendation, not a promotion here. Okay, please make sure that you understand the intent is to educate you, right? Motilal Oswal BSE Enhanced Value ETF, it is called MO Value. MO Value is the ticker. If you look at the AUM of this particular ETF, very small, 123 crores. PE ratio is very, very low, as I talked about it, and expense ratio is decent, 0.31%. It's not like 1% or 2%. The challenge that you need to note about ETF like these is that their liquidity is very, very low. Look at the trade information, the traded volume, only 79,000, okay, which is very, very low. So these are not for swing trading. These are not for like going and booking and doing some trading on the ETFs. Absolutely not. I do not talk about tradings. I only talk about mid to long term sort of investing, and that's where you need to learn about these particular indices. Again, I've tried to be very, very unbiased, have been to the point. And if you like that, request you to like the video and let me know in the comments. A simple thank you. With that, let's move to our ETF number 2 now. The second ETF that I want to speak about is based on Nifty 500 Value 50. Again, this one is a very, very good index to learn about. Okay. Last 1 year, total returns have been around 22.69%, 5 years, 34.88%, and since inception, 17.11%. Now, if we talk about this particular index's rolling returns. So last 3 years, if you look at it, and if you compare this with Nifty 500 versus Nifty 50, okay, so that we can compare it. Average returns have been better, 16.9% as compared to Nifty 500 and Nifty 50. And if you look at the standard deviation, it's been very, very high, 16.5%. Again, the fluctuations is very, very high. 5-year basis rolling returns, if you look at, much better performance than Nifty 500 and Nifty 50, 15.3 versus 13.1, 12.6%. So clearly, from a rolling returns perspective, it's done well in the last 3 years rolling return perspective and 5-year rolling returns perspective. What about the lump sum and SIP returns? If you look at lump sum and monthly SIP since 2005, right? So if you go back to almost 20 years of data point to point here, you will note that value from a lump sum and SIP perspective, both very similar profile, 17.1% versus 17.2. And as compared to Nifty 500 and Nifty 50, it has clearly outperformed. Now talk about the short and medium term, and more importantly, standard deviation and fluctuations, as well as risk adjusted returns. So from a standard deviations perspective, you see the data here, it's been very, very volatile. If you look at the last 1 year, 3 year, 5 year, 7 year, 10 years, if you look at the standard deviation, very, very high as compared to both Nifty 500 and Nifty 50, 16.9%, 19.9%, right? Almost 7 to 8% of higher volatility is what we have seen in this particular index. Now talking about the risk adjusted returns, very similar profile to BSE enhanced value index, that on 1 year, 3 year, 5 year, 7 year basis, this has done better. But when it comes to 10 years, the risk adjusted returns, Nifty 500 actually has outperformed this particular index. So you have to understand that over 10 years of time period, this hasn't done well from a risk adjusted returns perspective. Now, if I talk about this particular index's construction, how this is actually built. So we have the top Nifty 500 companies. Out of these 500 companies, 50 stocks are part of this particular index using something called as value score. And also here, there is a market cap factor also into selecting the stocks. Okay, so here it's not just about the value, it's also about the floating market capitalization, right? And from a value perspective, what are the factors? Simple, earnings to price ratio, or we generally call it price to earning ratio, but here it is talking about earnings to price ratio. Book value to price, sales to price, and dividend yield. Sales to price ratio is a new one here as compared to BSE enhanced value here. Okay, now if I talk about the sort of companies here, you will note the companies that are coming into this particular index is majority of them are PSUs. Okay, there are few private companies, for example, Tata Motor PV is there. Okay, but there are far and few between, and you can see majority of these are PSUs. Now, if I talk about the large cap, mid cap and small cap, this is where this is different from BSE enhanced value that we learned earlier. Here you will have the small caps as well, right? Because we're talking about from the top 500, take any 50, of course, any means the value plus market cap. And you see how the allocation changes dynamically here, right? So if you see the blue line, that is Nifty 500 value 50, and orange line is Nifty 500. See how the allocation changes here, but largely they are driven by the large caps, okay? So January 2026, they are almost having the same proportion of large cap, around 70%. Mid cap, if you see, around 18 to 20%, and small cap will be the remaining whatever 10%, okay, almost. But you see, if you go back to 2017, here the small cap used to be very, very high, almost touching to close to 30%. Mid cap used to be very, very low, around 8%, and the large cap used to be almost around 60%, right? So this allocation dynamically changes depending on where is the value. And here you're not betting so much on the market cap. In fact, you are betting on market cap, but not so much as on value. So you have to understand that philosophy as well. Now, how many ETFs are there? Only one I could find as of now, Axis Nifty 500 value ETF. Not a recommendation. You can please go and explore if there are any more since the time I've created this video. AUM is very, very small, 21 crores. These are not very popular indexes because there is a lot of volatility, and more importantly, people don't even understand how these indexes are constructed, how the ETFs work. And that is why I'm creating this video, so that at least you have the education, you have the information. PE ratio is very, very low, 8.36. Expense ratio is around 0.25%, which is decent in my view. Again, the liquidity is a problem here as well, as this is a very, very small ETF, right? Trading volume is very, very low, almost 86,000. That is very, very low in my view, and therefore the impact cost is very, very high. I hope you understand the concept of impact cost as well. If you don't, let me know in the comments. In coming videos, I might give you a bit more commentary on what is the impact cost and how should you look at impact cost when you're selecting ETFs, right? So this is all about this particular index and ETF, right? Let me now move to ETF number 3. Third ETF that I want to discuss is based on an index called Nifty 200 Value 30 Index. As of January 2026, what sort of returns this particular index has given? If you look at the last 1 year, 28.14%, 5 years, 36.14%, and since inception, 17.02%. So decent returns is what we have seen in the last 1 year, 5 year, and since inception. Now, if you look at the point-to-point returns from a SIP perspective and lump sum perspective and compare this with Nifty 200, because this index is made out of Nifty 200. And if you don't want to include small cap stocks in your investing because maybe you are afraid, or maybe because you don't like volatility, maybe because you don't like small cap stocks, then this index offers you large and mid cap space. So for example, here, if you talk about the returns, Nifty 200 Value 30, which is in red color, and blue color is Nifty 200. You can see the returns 1 year, 3 year, 5 year, 7 year, 10 year basis. It's easily outperformed Nifty 200. If I talk about the SIP returns as well, it's easily outperformed in all the parameters 1 year, 3 year, 5 year, 7 year, 10 year basis, right? But please understand these are point to point returns. The last 1 year or 3 year performance might skew the entire 10 year, 15 year performance here. Unfortunately, I could not find this particular index's rolling return data anywhere. Okay, but as soon as I find the data, I'll try to add you and or maybe cover that in some different videos, because it's extremely important to look at the rolling returns data as well. Now, how is this index selected, or how is this index built? So you take the top Nifty 200 stocks, and out of that you only select 30 stocks based on, again, the valuations, right? And you do some weight assignments and rebalancing semi-annual basis. So very, very easy selection here. The key thing here is that this is only considering the top 200 stocks, right? So it's very similar to BSE enhanced value rather than the second one that we talked about, which is Nifty 500 50 value index. Now coming to this particular index's sector allocation, financial services very high, 35%, oil, gas 27%, metals, mining 17%, power 9.5%, auto 5%, construction material 4%, chemical 1.2%. In fact, one of the good insights you can take from these indices is that whenever you see the particular sector is not here, you might think that that particular sector is not presenting you value opportunities, right? It could be, I don't know, reality sector not here, IT is not here, for example. You might think that there the valuations are very, very high. Okay, that is one way to look at it. It doesn't mean that it has to be true in the absolute sense, but relatively you can go and compare that. Coming back to the PE ratio, PB ratio, again, very, very low as compared to Nifty 200. PE ratio is very low, PB ratio is very low, dividend yield is very low. Here, one caution that I would give you is that just because the PE ratio, PB ratio is low doesn't mean that these companies will give you good returns. It simply means that their valuations are low. It may remain low forever. It is entirely possible. Some companies that are classified as value traps might also be in there, right? Again, let's have a look at the list of these companies here. So let me show you the list of the companies. As of now, top 10 companies you see, again, a lot of them are PSUs. ONGC, Vedanta, State Bank of India, Hindalco, Tata Steel, which is private, NTPC, Coal India, Power Finance Corporation, Bharat Petroleum Corporation, and Tata Motor PV. Only 2 companies are private in the top 10, but all are otherwise PSUs because the valuations from a comfort wise is there. Now coming to ETFs, there is only one ETF I could find at the time of creating this video, which is ICICI Prudential's Nifty 200 Value 30 ETF. Very, very low AUM, very similar to the other two, 24 crores only. PE is low. Expense ratio is okay, 0.30%. And from a liquidity perspective, this one is very different here because you see the volume here is 5 lakhs. Okay. So one could argue that this slightly presents you a bit more liquidity as compared to previous two that I talked about. Again, none of these are recommendations, but I hope you learned about 3 value ETFs. And depending on the market cycles, you can always go study these particular ETFs, learn more about them, and take investment decisions based on your research or by consulting your financial advisor. If you like this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content to you at zero cost. With that, I'm going to see you in my next video. Until then, keep rocking.